Good evening. Come to this wonderful standard IFRS 9 future contract. So today first few minutes we will take questions on derivatives. For that we'll understand the contract. What is a future contract? Is a derivative contract under which the buyer and the seller of a future have an obligation to buy and sell respectively a given quantity of the underlying asset at a given price at a given future date. Okay. For example, the two parties may enter into an index future contract. One party will say I want to buy, the other will say I want to sell, and they will fix a amount, contractual amount. Say for example 10,000 Nifty future. So underlying is the Nifty here. Nifty is the index of National Stock Exchange. A has bought, so A is buyer, B is seller. So technically we'll say A has taken a long position on Nifty and B has taken a short position on Nifty. B has taken a short position. So what A is thinking, that Nifty will go up. The buyer always thinks the price will move up. And what B is thinking, price will go down, Nifty will go down. Okay. So if Nifty goes up, A will make profit. If Nifty comes down, B will make profit. Similarly, the underlying can be a share future. Like for example, instead of Nifty, it can be shares of a company which is traded on the exchange, like Reliance future. They enter into a contract that A will buy, B will sell 1 unit of Reliance at 1,000. If Reliance price goes up, who is the winner? A. If Reliance price falls, who is the winner? B. Now in this example you have understood now, gain of one party is equal to loss of other party. So if A wins, B would lose the same amount. Features of futures. Okay. What are the features of a future contract? First, they are traded on the exchange, whereas forward contracts are over the counter derivative. Here the exchange acts as a counterparty default risk. Exchange acts as a counterparty default risk. That means the risk of default is zero. The exchange will ensure that the contract will always be honored, and for that they collect the margin money from the parties involved. Then future contracts are standardized. Standardized means most of the terms and conditions will be fixed by the exchange where you are trading. For example, the exchange will fix the quantity in which you can trade, lot size. The exchange will fix the quantity in which you can trade, that is called lot size. Say for example you want to trade in Nifty future. So the lot size is 50 units. One lot will have 50 units. Okay. Now you can't say I want to buy 23 Nifty. Not possible. You have to buy minimum one lot, and one lot has 50 units. Then there are underlying assets which are available for trading. All shares are not available for trading. All shares are not. The exchange says these are the 50 shares, these are the 100 shares on which you can take the position. There are more than 4,000 shares listed on NSE. Can you take position on all 4,000 share in future market? No. Only some of them are available for trading. So the underlying assets are also specified. The timing of settlement is also specified. Like in India, there are Maximum maturity is 3 months. And at a time you can enter into a future contract which will expire after 1 month or 2 months or 3 months. You can't say I want to enter into a future contract which will expire after 5 years. That is not available. Then even the contracts are settled on the last Thursday of the month. Contracts are settled on the last Thursday of the month. You can't say my birthday is 25th January, I want 25th January contract. Okay, not available. That is standardization. Why futures are so popular? Because they offer liquidity. You can buy and you can sell on any working day during working hours. Okay, you don't have to take permission of the counterparty. If you have bought, you can sell it. If you have sold first, you can buy it. Is it right? Buy, sell, always possible. And therefore, suppose on Monday you bought and you realize, no, my decision to buy is wrong. Tuesday you can sell it. No counterparty risk. Because the exchange is acting as a guarantor. Exchange takes margin money from parties. And how are futures settled? Although there are two ways of settlement. One is called cash settlement and one is called delivery based settlement. Cash settlement means only difference will be received or paid. Difference will be received or paid. So A and B have entered into a contract to buy one share of Reliance at 1000. Reliance price is 1050. A will get difference 50 rupees. B will pay difference of 50 rupees. Or they can be settled by delivery of share, but right now delivery based settlement does not take place in India. Okay, for shares. How does exchange ensure that the parties will honor their contract? They ask the parties to deposit initial margin. At the time of entering into the contract, they have to pay initial margin, and then on a daily basis, they have to pay mark to market margin. So two types of margin they have to pay. Initial margin, mark to market margin. Initial margin is paid at the beginning, which is based on some percentage of the contract value, say 10 to 15%. Okay. And mark to market margin is paid on the basis of daily movement in the price. If the price goes up, the seller will pay the difference. If the price comes down, the buyer will pay the difference. So on a daily basis, you are actually settling your contract, so that the risk of the exchange is reduced substantially. Daily difference has already been settled. Okay. And they have already collected the initial margin also, a lump sum amount. So the risk to the exchange is very, very less. But remember, future contract give rise to unlimited risk and unlimited gain potential. Both parties can enjoy unlimited profit or can suffer unlimited losses also. Okay. So before you enter into future contract, keep these factors in mind. Now we'll come to journal entries in case of future contract. When you want to enter into future contract, you will have to pay initial margin. Simple entry, initial margin account debit to bank. As a student of this subject, these figures will be given to you. How is initial margin calculated? You don't have to worry, it is given to you. Otherwise, it is calculated by the software of the stock exchange. Okay, and the software does the calculation that for this share, for this maturity, this lot size, etc. You put the variables and they will calculate the initial margin and say this is how you have to pay the initial margin. If suppose you are a regular trader in future, it is better to keep a control over which future you are buying or selling. Is it right? So you give a good name to it. Nifty index future account. Okay. Reliance future account. gold future account, whatever is that underlying, because then at the end of there your trial balance should be able to distinguish these are the 7 different types of futures. If you just open one account, then you can't keep a control which initial margin was paid for which account. So it's better you open a separate account for each future. Okay. And then initial recognition of future contract. Second entry, you have to pass an entry at fair value. Derivatives are measured at fair value on the date of acquisition. Normally, usually, the fair value of the future contract will be nil on the date of acquisition, because you buy it at the market price only. You enter into a future contract at the ongoing price only, right? So future contract account debit to bank account. But the entry will be for nil amount. So in fact, you may not pass this entry, you can just write a note in the answer. No journal entry is required because the fair value is nil. And then you have to pay mark to market margin. Both parties may be required to pay mark to market margin, the buyer also and the seller also. When will the buyer pay mark to market margin and when will the seller pay mark to market margin? If you are the buyer of a future, or if you can understand, if you have a long position on future, if the closing rate for the first trading day is less than contract rate, on first day will compare with contract rate, first day, and then subsequently will compare the last closing with today's closing, or closing date for subsequent trading day is less than the closing date for the previous trading day, then you will have to pay mark to market margin. Okay. Now, to understand this line, suppose A and B enter into a future contract. A is buyer, B is seller, and the contract price is, let us say 1000. Contract price is 1000. Okay. Contract price is 1000, and this contract was entered into on say 1st April 2020. Now on 1st April 2020, at the end of the day, now the future is trading at 980. Future is trading at 980. Today we entered into contract in the morning, the market closed when the future is now trading at 980, which means I am having a gain or a loss. A. This heading is for purchaser. So I have a loss of 20. 20 rupees I will pay as mark to market margin, MTMM. Next day. What is next day? 2nd April 2020. Now it is 970. Now the Nifty future is trading at 970. Again we are losing or gaining. But now you will compare with which date? 980. This difference we have already paid. Now we will pay this difference, 10 rupees. So Mr. A will pay 10 rupees mark to market margin. Is it right? The buyer of the future will pay mark to market margin when price will fall. Okay. Second thing, on the first day when you enter into the contract, it will be the difference between the closing price and the contract price. This is this line. And if it is subsequent day, it is the difference between previous closing and current closing. Okay. So this is how they will pay mark to market margin. Journal entry will be mark to market margin. Again, to keep a tab on for which future you are paying, you can give it a good name. Okay. Nifty index future account. In case of seller, same example, but I'll make it a small change. Suppose now we have to look at this question from B's point of view. Hello, don't sleep. Now we are looking at the question from B's point of view. Contract price is 1000. market price at the end of the day is 1020. Who will pay? B will pay, because B has agreed to sell at 1000 and market price has gone up. Okay, in derivative market the buyer expects price will rise, the seller expects price will fall. His expectation has gone wrong. So 20 rupees mark to market margin he has to pay. Next day, suppose the market price of this future rises to 1030. Again, 10 rupees mark to market margin you have to pay. Journal entry, mark to market margin account debit to bank. When you receive the mark to market margin, the receiver will pass the entry, bank account debit to mark to market margin account. One party is paying means other party is receiving. So simultaneously the other party will pass the opposite entry. Okay. So we will practice one or two simple question on this. They will not ask a very difficult question. And then subsequent measurement of a future contract. Suppose in between your reporting date has come. So you will revalue your future at fair value. You will revalue your future or whatever derivative is that at fair value. Right now we are talking about future contract. Then we'll discuss the same thing for option also after some time. So the entry will be, suppose there is a decrease in value. Suppose there is a decrease in value on the reporting date. Entry will be P&L account debit to future contract. Being the loss on revaluation of future contract. Note is printed. Reverse entry will be passed in the case of revaluation. Reverse entry will be passed in the case of revaluation upward. If suppose the value goes up, fair value of future contract goes up, then we'll pass the entry future contract to profit and loss account. Okay. So on every subsequent reporting date, you have to see whether the value of the future contract has gone up or has come down. Again, these calculations will be given to you and you will be able to do it. And now suppose you want to square up or settle the future contract. Square up means if we have bought a future but we don't want to continue, then we will sell the future. And my contract is squared up, means closed. Or on settlement date, we have to in any case close the contract. Okay. So in case if you settle that future contract, there are two possibilities. You may win or you may lose. So bank account debit. In case you are winner, difference received, then derecognize future contract. If it has a credit balance, debit. Below also I have written to future contract, because now I am settling or squaring up the future contract. So that account will be derecognized. Yesterday you have learned derecognize when contractual right to receive cash flow has expired, or when the liability is settled, extinguished, cancelled. Is it right? So we are derecognizing the future contract. So before passing this entry, check whether it has a debit or a credit balance, close it. Then you will find I have written P&L account also 2 times. If there is a loss on squaring up, P&L account debit. If there is a gain on squaring up, P&L account credit. Okay. And after your future contract is settled, you will get the refund of initial margin. After the future contract is settled, you will get the refund of initial margin. So bank account debit to initial margin being refund of initial margin money that was deposited. Okay. Now we'll solve some simple examples. So far we have only seen simple examples on this derivative accounting, because not everybody is smart like you. Mr. A enters into future contract on 28 March 2018. Initial margin is rupees 30,000. So how much he has to pay on this date? 30,000. It is like a deposit. It is not an expense. Don't transfer this to P&L account. It will appear in your balance sheet as an asset. Okay. As a current asset, as a current financial asset. Okay. Because the amount will be received back in cash once your contract is settled, squared up, honored. Initial margin on subsequent days were as follows. Now, even initial margin, the exchange can ask you to bring more money also. Is it right? Depending upon the movement of prices, they may ask you to bring more initial margin. So next day, the initial margin requirement is 35,000. Initial margin requirement is 35,000. So 5,000 rupees more initial margin you have to bring in. Then on 30th March, 25,000. So you can withdraw 10,000. Again 27,000. Again 2,000 rupees you have to bring in. It's a very hypothetical question because every day normally initial margin money is not required to bring in. Okay. But you can't write that in the exam. Pass the entry. Pass journal entry without challenging the institute. So date particulars, debit, credit, first day we will write initial margin account debit 30,000, initial margin account debit 30,000 to bank account 30,000. You want to write narration also? Those who want to write fast. Initial margin paid to buy future. And then you just have to repeat these entries. If you pay more, same entry. If you get the refund, reverse the entry. So next day what will happen? We'll pay more. How much more? 5,000 more. 30 I have already paid. Now the requirement is 35,000. The calculation of this you will learn in a subject called strategic financial management. Okay. So in this subject it will be given to you, these numbers. So 29th March, now the exchange says you have to keep an initial margin of 35,000. So then this future participant will have to bring additional 5,000. Will pay additional 5,000 initial margin to bank. Initial margin to bank 5,000. Initial margin to bank 5,000 being additional initial margin money paid. Being additional initial margin money paid. Next day it is 25,000. Question is designed just to check your knowledge of accounting. That's it. Okay. So now you get the refund of 10,000. Bank account debit. Bank account debit, how much? You will get the difference? 10,000. 35 minus 25. To initial margin 10,000. To initial margin 10,000. Okay. Being initial margin money received. And then next again you have to pay 2,000. Initial margin account debit to bank. So my purpose of putting this question is just you should know this is how the initial margin accounting is done. Being initial margin money paid. Being additional initial margin money paid. How much is the amount? 2,000. That's it. Now we'll go to question number 41. Mr. A enters into future contract, and in bracket they have written long. So he has bought. He is betting that the price will go up. He is betting on upward movement of price. Okay. Futures are like betting only on the price movement. Of course, it is used for hedging purpose also. For 100 shares at 300 rupees each, He paid rupees 5,000 initial margin. In this problem, I am going to combine initial margin and mark to market margin. Okay. And we are going to settle this contract also. So we'll go up to the end. Date of contract is 27 July 2018. So today is 27 July 2018 in this problem. Settlement date is 29 September 18. So we have to go up to 29 September 18. Price of the share on the subsequent days were as follows. 27th July 18 only, that is at the end of the contract date. Today we have entered into contract 27 July. At what rate? 300. Closing rate 315. 315. Now tell me which of the two is right. Mr. A will have this face or Mr. A will have this face. Option A, option B. On 27 July 18. A. Why? Long. So we'll have a long smile. Okay. Because now there is a potential gain of 15 rupees. On next day, now they have not given up to 29 September, otherwise your 3.5 hours will be spent on that only. Is it right? So, means every day price will change and every day you have to pass the entry. So, on this date, again you have to check the difference. One more smile. Loss. Loss. Smile. And then you have to revalue your future on this date and close all the related accounts. And close all the related account and you will receive the refund of initial margin. Is it right? So write down in the books of Mr. A, or in the exam they will give you A Limited. This is for understanding. This is how the entries are passed. Journal entries, draw one page format in case if you want to draw the format. Date, particulars, debit, credit. First we will have to deposit the initial margin. First we will have to deposit the initial margin. What is the initial margin in this problem? 5,000. Is it changing throughout the problem? No. Initial margin in this problem is not changing. So write down initial margin account debit to bank, 5,000 being initial margin money paid to buy future. And then on the same day, you found that the closing price is now 315, whereas we have entered into a contract at 100 rupees. So I am going to receive mark to market margin. If the price goes up, I will gain. So in future market what happens? They settle the difference on a daily basis. They settle the difference on the daily basis so that the risk is reduced. At the most now what is the maximum risk of one day? Tomorrow the price will change, other party may default. If I wait for 2 months, by this time the price would have gone up by so much amount, and then the other party defaults, it's a significant risk. So what the exchange does? Every day you settle. Every day you settle. So at the most I will carry a risk of only one day, one trading day. So I will receive bank account debit to market margin. 1500 you understood? 100 into difference between 315 and 300. Next day, a bigger smile. Market price is 350. And yesterday or before that it was 315. Again the same entry, bank account debit. Bank account debit 3500. Calculation write down 100 into 35. And that 35 is 350 minus 315. To market margin account. MTM. Mark to market. Next day, there is a decline. Sad. 10 rupee decline. Now you pay the mark to market margin. 10 rupee into 100. Date write down 16th August. MTM account debit to bank account 1000. MTM to bank 1000. Done? No? Yes. One more entry. On 29th August. No. 31st August. Again there is a decline. Yes or no? How much is the decline? 50 rupees. 50 into 100. 5000. Entry M2M. MTM account debit to bank. 5000. One more. Now it has gone up. 20 rupees. Entry. Come on. Bank account debit to MTM. 20 into 100. 2000. Very good. Being marked to market margin received. Narration you have to write MTM paid, MTM received. MTM paid, MTM received. Okay. Now we'll take a stock of situation right now. What is the balance in MTM account right now? Because that account also has to be closed. You have to only tell me what is the balance in MTM account. 1000 rupees? 1000 rupees debit or credit? Credit. Credit balance. We have received 1000. Okay. So mark to market margin is 1000 rupees. Initial margin 5000 rupees debit. Okay. What was my fair value of the future contract when we entered into future contract? 0. My fair value of future contract was 0. And now when I entered the future contract, we entered at 300 rupees. And today when we want to square off, it is 310. So fair value of future contract will rise. Is it right? By how much? 10 rupees. Because the future contract gives me a right to buy at 300 rupees, and on the squaring of date, settlement date, it is 310. So I am gaining 10 rupees. So now I will revalue the future contract on the settlement date. So entry will be future account debit. DFI means derivative financial instrument. DFI. Derivative financial instrument. If you want to write, otherwise just write future. Derivative future account debit 1000. This is the revaluation of future, resulting into a gain, because original value was 0, which entry I have not passed. Fair value of future on initial recognition was 0. Now it is 1000 rupees because we are gaining 1000 to P&L account 1000. So this is my profit on this entire deal. Okay. And now, have you written the entry? Now that 1000 rupees I should receive because I am gainer, but I have already received it. I have that M to M account 1000 credit balance. What is that? That is the difference. I have already received. So I will now cancel this two account, knock off this two account. MTM account debit 1000, which is the balance in my account, which is the profit I have earned, and to DFI account 1000. So MTM account debit to future account 1000, being future settled. Okay. Again you will not receive 1000. Some students say, sir, we have won 1000. Should we not pass entry bank account debit to future 1000? For last 1 month what you were doing? This is the difference you have collected over a period of time, 1000, and now it is lying in your MTM account. That is 1000. It will always match. It will always match. Because what we have done in MTM account, we started with 300 to 315 difference, 315 to 350, 350 to 340, then 290 and 310. So ultimately, either you calculate in piecemeal or you directly take the end-to-end difference, it will be the same. Yes or no? So don't pass. My purpose is don't pass one more entry bank to future account. You will not get it. Contract is over. You have honored the contract. Now the exchange will refund you the initial margin. So don't forget to pass one more entry, bank account debit to initial margin account, to initial margin account 5,000. Okay. This way this question will be solved. Now we'll ask you a theory question. Question number 42.
What if we transfer the MTM margin balance directly to P&L instead of introducing the future account?
One student is asking, what if we transfer MTM directly to P&L account? That also can be done, but normally first we have to bring the future contract, fair value of future contract. Future contract is there in our book, but it was at nil value. So we'll have to first revalue it. Is it right? And then we will knock it off. In this problem, year-end date has not come. Okay. But suppose between the entering into the contract and settlement, an year-ending date will come. Then you will have to create that future account in your books. Is it right? And then you will have to knock off against MTM account. So better you route it through this way. Effect in the P&L account is same, but then in financial statement we have to present the future contract also. What is the fair value of future contract we are carrying? Now one theory question. Let us see who will give the correct answer. Entity XYZ, whose functional currency is in Indian rupee. Which standard defines functional currency? Effect of change in foreign exchange rate, IS 21. Okay. Sales products in France denominated in euro. So is there any risk to this Indian entity? Yes, they will receive the payment in euro. XYZ enters into a contract with an investment bank to convert euro to Indian rupee at a fixed exchange rate. So they took a forward contract that we will deliver you euro and you deliver us rupees at a certain exchange rate which they have agreed. The contract requires XYZ to remit euro based on its sales volume in France in exchange for Indian rupee at a fixed exchange rate of 55 rupees per euro. Is this contract a derivative? You have a contract which gives you a right to sell euro at 55 rupees per dollar. So does this contract has similar feature like a derivative? Is it a derivative? So you have to apply three features of derivative. Does it require any initial investment? In this example, no. You just have to sign a contract. Second, will the value of the contract vary? Will the value of this contract vary as the exchange rate between rupee and euro varies? Yes. You said no. Dear student, fixed rate, that is why it is risky. If suppose the value of the euro goes down to 45, you will gain. If it goes to 65, then again you have to deliver it at 55 only. Is it right? So your contract acquires a value. Suppose the exchange rate goes to 50. So you still can use this contract and sell euro at 55. So don't you think your contract generates a potential gain for you? Yes. Your contract acquires a value because the person holding this contract can sell euro at 55 if the market price is 50. So contract has a value because it gives you a power to sell euro at 55 even if the price falls, rate falls. Will it be settled at a future date? It will be settled in future. So therefore this kind of contract has all the ingredients of a derivative product. So you write down yes. A student will write only up to this. But write two more lines. Why yes? Just define derivative. They are checking your derivative definition. knowledge. Okay. Yes, the contract has two underlying variable. Its value will change as the rate of exchange will change, and in this question it will also vary as the quantity will change, because quantity is not fixed here, it depends on sales volume. So value of your contract will vary because of two reasons: the foreign exchange rate and the volume of sales. Second reason, write down: no initial net investment. No initial net investment or initial net investment that is smaller then would be required for other types of contracts that would be expected to have a similar response to changes in market factors. That would be expected to have a similar response to changes in market factors and a payment provision. So it does not require initial net investment. You can write this much also. Or it requires an investment which is much lower than what you would otherwise require. And you write one more line below, which is not printed. It will be settled at a future date. These three lines you have to write in case if you think it has all the features of a derivative. Its value changes in response to change in the value of underlying, which in this example is exchange rate and the volume. It will be settled at a future date. It doesn't require initial net investment or very low initial net investment. Then what you would require to reduce the risk completely by using other contracts. Now dear student, one more important question. First write very important, then we'll talk further. On 1st January 2009, Future Limited, it's the name of a company, Future Limited entered into a contract with Sun Limited to receive the fair value of 1000 Future Limited's own equity share outstanding as on 31st March 2010. So it is a contract to buy your own share. 1000 own share in exchange for payment of rupees 1,04,000 in cash. That is rupees 104 per share. So it's a contract to buy a fixed number of own share against a fixed amount of cash. But read the next line. The contract will be settled in net cash. So it is not going to be settled in the form of 1000 equity share. That you give me 1000 equity share, I'll pay you 1,04,000. They're only betting on the price of their own share. You're betting on the price of your own share because it's a net settled future contract. So net settled future contract will be derivative. You can ask me, sir, is it a fixed for fixed test is satisfied? It's an equity instrument. It is neither financial asset nor financial liability. You are not right, because there is a next line which says the contract will be settled net. Only net amount means you are just betting on the price movement. You are not actually going to receive share. You are not actually going to pay 1,04,000 rupees. The fair value of the forward contract on the different dates were. Now this calculation they have done for you. Question is for Future Limited. So on day of entering into the contract, 1st February, the fair value is nil. Then between these two dates, the fair value of the forward contract has increased from 0 to 6300. So I will account for this change in fair value of derivative. Again, between these two dates, the fair value has reduced. Again, I will pass an entry for decrease in fair value of this forward contract. So what is your net gain or net loss in this deal? 2000 rupees. Because now the fair value of the forward contract is 2000 positive. So who is the winner? Future Limited. It will receive rupees 2000. Presuming that Future Limited closes the books on 31st December, pass journal entry if the net is settled in cash. So 2000 rupees difference you will receive in cash. And if the net is settled, net amount 2000 rupees is settled by Sun Limited by delivering the shares of Future Limited. So it is just the mode of payment which is changing. Instead of paying 2000 rupees in cash, I am paying 2000 in the form of equity share of Future Limited. And I am Future Limited myself. So for me it would amount to acquiring my own share. It becomes treasury share. It becomes treasury share. So I will debit equity account. I will debit equity account. Is it right? So many concepts they are testing in one simple question. Now, dear student, first write down in the books of Future Limited, journal entries. Case 1. Case 1. If the net is settled in cash, if the net is settled in cash, draw the format of journal, date, particulars, debit, credit. Keep question in front of you. It says the fair value of the forward on 1st February 2009 is nil. So entry write down 1st February 2009. No entry is required. No entry is required because two reasons. One, fair value of derivative is 0. And second reason, no cash is paid or received. There is no initial margin in this problem. There is no initial margin. Previous problem had initial margin. So no entry. Fair value is nil. Cash received or cash paid is also nil. Can you pass the entry on 31/12/2009? 6,300. But entry. Derivatives are recognized at fair value and change in fair value is transferred to profit and loss account. So first of all, I am gaining or losing? Gaining. From 0 to plus 6,300 is gain. So P&L account will be credited. And debit. You can give a name to the account, future account, forward contract account. In the exam, suppose your mind is blank, derivative account. Okay, for every derivative product. So this is a forward contract and contract is favorable. Contract is favorable. We will exchange financial asset and financial liability under conditions which are potentially favorable. So it becomes a financial asset for us. So forward contract asset account debit to P&L account 6,300. You can give a similar name, no problem. And if you want to answer questions in the exam, write a small narration also. Gain recorded due to increase in fair value. Gain recorded due to increase in fair value. Then you come to 31st January. From 6,300, you have moved down to 2,000. So entry will be passed for 2,000 or 4,300. Yes, you have to reduce it. You have to reduce the value of the future contract to 2000, which means you have to pass an entry like this. 31st January 2010, P&L account, debit 4,300 to forward contract. Whatever name you will write in this entry, you just copy the same here. On the credit side, 4300, narration, loss recorded. Loss recorded due to decrease in fair value. Loss recorded due to decrease in fair value of forward contract. One last entry, net is settled in cash. Now let us examine this three entry. What is the balance in forward contract account? 2000 debit. That difference will be settled in cash. First case 1. So you will receive 2000 rupees and you will close this account. Okay. So next entry will be bank account debit. Cash or bank account debit. Cash or bank account debit 2000 to forward contract asset account 2000 being forward contract settled in cash. Being forward contract settled in cash 2000. Is it right? Now the question is not over. If the net is settled, net amount is settled, means 2000 only, by delivering shares of Future Limited. So tell me, dear student, will the entry number 1, 2 and 3, will they change? First, second, third entry. First, second, third entry will not change. Only the mode of settlement is, instead of paying cash, they are giving you your company share. And it is my own company share, so I have to debit the equity account. I can't write investment in equity share of my company. You have to cancel it. So now write down below that in your notebook case 2. Close that first format. Case 2, write if the net settled is by delivery of shares. If the net settled by delivery of shares. I have written a note, write down note, first 3 entries will be the same. Or you want to copy again?
No.
Same. I know. Entry number 4 will change as under. Entry number 4 will change as under. Same entry, but instead of writing cash, you write equity. Now you can ask me, can we write equity share capital? The answer is no, because I don't know how many shares were paid to me and what is the face value. So equity means it will affect share capital and reserve both, but individually I don't know. Individually I don't know how much will go to equity share capital account and how much will go to reserve account. So better you write equity. Then your question will be, can this way you can acquire your own share? This amounts to buyback of share. So one has to also see the legal framework of that country, whether it is allowed or not. In India, section 68 of Companies Act 2013 will not allow this transaction. You can buy back own share only by complying with requirement of section 68, 69 and 70 of Companies Act 2013, and if you are a listed company, then you have to further comply with SEBI buyback of shares regulations. Is it right? Where this method is not prescribed. Either you can go only by offer for sale method or by tender method. And plus you have to check your reserve and other things before you do debt equity ratio. Anyway, when the question comes in the exam, solve and come home. Next few questions are on options. Okay. So first I will revise options quickly. You know it and it is very simple. What is an option? Option is a right, but not the obligation. It's an option. That is why it is called right but not the obligation, to buy or sell a specified quantity of a specified underlying on a specified date at a specified price. It's a right but not the obligation to buy or sell a specified quantity of a specified underlying on a specified date at a specified price. So what you are doing, you are entering into a contract. A and B, two parties are entering into a contract, and A says, I want to buy, say for example, Reliance Industries Limited share from you after 3 months at 1000 rupees. Is it right? So they have specified the underlying. What is the underlying in my example on the screen left side? RIL share. Quantity, 1 share, example. Specified price, 1000 rupees. Time, 3 months. Okay. Who has the option? Only one party can have an option. Both parties can't have an option. Is it right? If both parties have the option will never get exercised. Because one of the two parties would be on the losing side and one will be on the winning side. So if both parties have the option, the loser will always refuse to honor. So A, suppose, go to B and say, I want to buy, but I want to buy only if the price goes above 1000, and I don't want to buy if the price falls below 1000. B will say, oh, you are the only smart one. If price rises, you will buy. And if price falls, you will not buy. So I am going to suffer the loss. So then A will say, I will give you a compensation for taking this risk. And that compensation is called option premium. Okay. So 3 more terms you have understood. One is called option holder. The party who has the right, but not the obligation. And then option writer, the party who has the obligation to perform, if demanded by option holder. And then option premium, the compensation paid by whom to whom? Compensation paid by holder to writer. Okay. It's like insurance premium. Just compare this with insurance premium. So you have a bike. You go to insurance company. So we call sometimes insurance underwriters also. Because what they are doing, they are taking the risk. You pay the premium. If your bike meets with an accident, then they will pay you the compensation, which is like the option gets exercised. But if your bike does not meet with the accident, the option will lapse. They will not pay you anything back again if the option lapses. Is it right? So if the option is not exercised, the option is lapsed. The premium paid is a cost to the buyer. He will not get it refunded. It is different from initial margin money. Initial margin money is deposit, refunded on honor of the contract. Premium is the cost of buying the option. Premium is the cost of buying the option. And therefore it is a cost for you, income for the other party, it will not be refunded. There are 2 types of options. Call option, put option. Call option gives the holder the right to buy at exercise price. Exercise price is also called strike price or specified price. He has a right to buy the underlying asset at the specified price, but not the obligation to do so. But not the obligation to do so. Second thing you remember, that call will be exercised. When will call be exercised for solving all the questions that are going to come now? When market price is greater than exercise price. Market price is greater than exercise price. Because the call holder, he expects the price will rise. That is why he has entered into a contract to buy at a fixed price, predetermined price. If the price rises, he will make the profit. What is the profit under call option equal to? Profit under the call option is equal to maximum of market price minus exercise price or 0. Profit under call option for the call holder is equal to higher of the two. Share price minus exercise price or 0. It can't be negative. At the most it will lapse. Of course the premium paid is your cost, that is separate. On exercise of the call option, your profit will be market price minus exercise price. On lapse, your value of the call becomes 0. Same thing applicable for call writer also. Okay, but call writer has an obligation to sell. Call writer has an obligation to sell at the exercise price. Call will be exercised by the holder when market price is more than exercise price. For the call writer, I will use the same formula, but instead of profit, it will become loss. If the option gets exercised, then his loss will be market price minus exercise price. If the option lapses, 0. He can't make profit on exercise of the option. He can only make profit equal to premium received. How much profit insurance company makes from you? Premium. Can they earn more than that from you? No, they can't. Same thing for writer. Now I'll just quickly summarize put option also. Put option is a right to sell at exercise price. Right to sell is with whom? The holder of put option. The one who has paid the premium to acquire this right. He has a right to sell at the exercise price. What does put holder expects? One more line I will add now. Put holder expects price will fall. He expects price will fall. Derivative market is a market where you can make profit in rising market also, and you can make profit in a falling market also. A derivative player may think, oh, the price is going to fall. Why not to benefit? Is it right? Next year Mayawati will become Prime Minister, share price will fall. Let us buy lot of put options, sell my lung, kidney, heart and invest in the put option. Okay. Example only, don't do that. He expects the price will fall. So now my question is, put is exercised, put option is exercised when market price is dash exercise price less than, equal to or greater than? Less than exercise price. Okay? Because he was expecting that the price will fall. Price have gone down. Your expectations are correct. So you'll exercise your option. And the last thing I need to write, I will write somewhere below, value of put. Value of put will be maximum of or higher of the two. Exercise price minus share price, market price, or 0. So for the holder, this is the profit formula, and for the writer, this is the loss formula. If the option gets exercised, you will make profit. Suppose your exercise price is 200 rupees and market price goes down to 100 rupees. So holder will be very happy to exercise his right and sell at 200, whose market value is 100 rupees something. Correct? You have a right to sell at 200 rupees. Market price is 100. Will you not sell at 200 rupees? Yes. So you'll make 100 rupees profit. Okay, so in practical world, they don't actually deliver the share and collect 200 rupees. They just do the net settlement, which is equal to the difference between exercise price and market price. But if the option lapses, value of the put option is 0 for both the parties. Okay, value of the put option is 0. Now, when will an option lapse? Option will lapse. Put option will lapse because the formula will change for call. Put option will lapse when market price is more than exercise price. Now see the logic. You have a right to sell at 200 rupees. Market price is 400 rupees. Would you exercise your right and sell at 200 rupees when you have an option not to sell at 200? Sell in the market for 400 rupees. I have a put option to sell this pen for 200 rupees. After 3 months, the market price of this pen has gone to 400 rupees. Will I sell to the counterparty B or will I sell in the market? Markets. That means with respect to counterparty B, my put option would lapse. Lapse means zero value. This is what we have learnt in strategic financial management subject. Okay. Now in this subject, you have to see the accounting. So basically your accounting would involve here one, premium received paid depending upon whether you are holder or writer, option being a derivative, and derivatives are measured using fair value technique. Every reporting date you have to do the fair valuation, and change in fair value will be recognized in P&L account, and then on settlement date again you have to check whether there is a gain or loss, and that will be recognized in profit and loss account. That's it. And if it is a delivery based settlement, then you will receive or deliver the shares at the exercise price. Then you will receive or deliver the shares at the exercise price. Normally delivery based settlement are not asked. But one small question later I will take on delivery based settlement also. Right? Now this question will only test your understanding of call and put. No accounting entries involved right now. The market received rumor about ABC Corporation's tie-up with an MNC. So there is a rumor in the market. ABC Corporation is tying up with a multinational company. So this is a price sensitive information. This has induced the market price to move up. If the rumor is false, but suppose it turns out to be a false information, ABC Corporation stock price will probably fall dramatically. To protect this, to protect from this, an investor has bought the call and put option. This is really a useless paragraph. You have to see what he has done. Accordingly, your answer will have to be written. The story is right now in this question not relevant. He purchased, means he has a long position. Bought, means he is the holder. He is the holder. He purchased one 3-month call with a strike price, means exercise price. Strike price means exercise price. This is the price at which he has a right to buy at 42 rupees one share, and for this he paid 2 rupees premium and paid 1 rupee per share premium. One more premium is paid for a 3-month put with a strike price of rupees 40. Call option, exercise price is 42, premium paid 2. Put option, exercise price is 40 premium paid 1. Now, and in both the case he has a long position. Why will a person enter into this kind of contract? He is buying a call also expecting price will go up. He is buying a put option expecting price will fall. Because he is uncertain what will happen. If the rumor is true, price will rise. He'll make profit on call. If rumor is false, price will fall. He'll make profit on put. Now he is going to make profit whether the price goes up or comes down, but yes, you have to pay 2 plus 1, 3 rupees premium for that kind of situation. Okay. Now the institute is testing you. Determine the investor's position if the tie-up offer beats the price of ABC Corporation to 43 in 3 months. So what happened to market price now? 43. Market price 43. Now whether the call will get exercised? Exercise price is 42, market price is 43. What action the investor will take? Exercise. But put option will lapse because market price is more than exercise price. Why will you sell at 40 when market price is 43? So let it lapse. 43 exercise and lapse. Now next question. Determine the 2 questions they have asked. Determine the investor's ending position if the tie-up program fails and the price of the stock falls to rupees 36. So now suppose the market price is 36. Call will lapse, put will exercise. That's it. First you have to understand this basic concept. Now you have to then calculate gain or loss in situation 1. Option will get exercised. You will make a profit of 1 rupee. But for that you have to pay 3 rupees premium. So net loss will be 2. In second case, call will lapse, put will be exercised. So you will make some profit here. 40 minus 36, 4 rupees. And total premium you paid for this deal, 3. So how much is the net profit? So in first answer we have a net loss of 1 rupee, 1 or 2? 2 rupees. And in the second answer we have a net gain of 1. That's it. And you will get some 3-4 marks for this much efforts. No, there is nothing to laugh. You have to know what you have to do. These are technical things. If you know it, it's easy. Dear student, write down. Next question will pass journal entry. Calculation of gain or loss. Calculation of gain or loss to the investor. And we will solve in a tabular format, both answers in one table only. Right hand side write down market price on expiry date under the 2 columns 43, 36. Point number A. Value of call option. Call option has an exercise price of 42. 42 is exercise price, market price is 43. Call will be exercised. Call will be exercised, you have a right to buy at 42. Market price is 43. So if you exercise it, you will get the difference of 1. Okay. In a stock exchange, they automatically transfer 1 rupee into your account. You don't have to tell them also, I want to exercise. You will exercise. You are a human being, greedy fellow. So after winning 1 rupee, you will not say, no, I don't want to exercise. You will. And then in the second column, it will lapse. You will not pay 6 rupees difference. It is an option. Option will lapse. You don't have to pay the difference. I will exercise if I want. I will not exercise if I don't want. So I will say the counterparty, I don't want to exercise. Option will lapse. Okay, try this one. value of put option E is equal to 40, market price is 43. Option will lapse. If it lapses, the value is 0. But in the next column, 4 rupees gain. Total 1 and 4. This is called gross payoff. Gross payoff. That means before adjusting premium. Gross payoff. Point number C. Less premium paid. On call option 2 rupees. On put option 1 rupee. Therefore 3. This I have to pay at the beginning only. No choice. That is why you get the right to buy or not to buy. Right to sell or not to sell. So what is my net payoff? 1 minus 3 minus 2, 4 minus 3, 1. Right? Any query on this wonderful question? No? Now we'll take a break.